Hi guys, welcome back to Nairobi Legal Insights. In today's video, our focus is going to be on accounting for lawyers, and I'm going to be laying out the fundamental principles and concepts you must understand in accounting that will guide you to build onto the progress that you'll have as you're attempting accounting questions, especially when it comes to the mathematical questions. By the end of this video, you will be in a position to know what accounting is, what are the parties that are interested in accounting information. We are going to be discussing about assets and liabilities. These concepts bring a lot of confusion. You will be able to understand what revenue is, what expenses are, and as we go along, then you're going to be able to look at a mathematical question and be able to point out assets, liabilities, point out equity, capital. So this is what we intend to achieve by the end of this specific video. Our very first definition will be what is accounting, and as you can see from your screen, accounting is about providing useful information to users of financial statements, more so to the providers of funds. Now, in the course of this video, we are going to be able to appreciate this definition much better. But the key concept or objective, as you can see from this definition, is that you're providing useful information to people who actually need to understand and use these financial statements, especially the providers of funds. And in the next slide, you're going to be looking at more parties that might be interested in accounting information. Now, the next question you ask yourself, what is the use of these financial statements to the providers of funds? Now, we know that companies have shareholders, and shareholders have invested their money into the company, expecting to get a dividend whenever a company declares profits, and it goes ahead to pay dividends out of the earned profits. So when you have access to these financial statements through accounting, as a shareholder, then you're able to know what the company used to have, what the company currently has, and what it intends to have in the near future. Remember, numbers don't lie. So with access to financial statements that are generated through a provision of useful information guided by accounting, we are able to know where we used to be, where we are currently in terms of what we own as a company, and what we intend to achieve in the near future. So in simple terms, that is the definition of accounting. Now, the other parties interested in accounting information are the government. We have lenders. These are financial institutions that give loans to companies. We have customers of a specific company. We have employees, trade unions, and academicians. As you can see from your screen, I have put rationales as to why these parties might be interested in accounting information. For the government, specifically Kenya Revenue Authority, it would want to know this accounting information of a company, especially the financial statements, as a way of assessing the taxes that will be payable at the end of the financial year. Then we have lenders. Remember that companies operate on equity financing. They also go for debt financing. So a company could approach a bank when it's facing a liquidity problem. When we talk about a liquidity problem, what we mean is that a company has some money to operate. They have assets, but they need some more cash to just run the daily transactions of a company. So it may then go to a bank to get some financing, and that bank will be interested in these financial statements, these accounting statements, in order to assess whether that specific company is in a position to pay back that specific loan within the agreed period of time. So remember, in the previous slide, we talked about how someone will look at accounting information and assess where the company used to be, where it is currently, and where it intends to be. So this information again becomes very useful to a bank to assess whether this company can be given a loan. So customers of a company are also interested in actually having access to financial statements of a company. So you may be wondering, why does a customer need this information? Remember that if a customer, maybe that specific company is involved in manufacturing, and a customer buys supplies from that specific company, this customer needs to know whether this company will actually operate for a foreseeable future. If a company maybe stops operating next month, then the customer might not have access to the materials he or she has been purchasing from that specific company, and that breaks down the business trade chain. So in essence, customers need this information to determine the going concern of the company. And when we talk about the going concern of a company, it could also be referred to as the continuity assumption. So basically, the assumption provides that a business should be able to operate for a foreseeable future. So just to give you an example, when a business or a company pays rent, they pay rent knowing that they will continue operating for a foreseeable future. So you've paid 6 months in advance, 7 months in advance, with an assumption that you'll be operating over that period of time. So customers also need this information to basically determine the going concern of the company. Now, also we have employees who are key stakeholders in companies. They need this accounting information to assess their job security. Remember that if a company is doing well, let me use an example of Safaricom. The company is doing well, there are profits being declared, shareholders are being paid dividends. Even you as an employee, you feel secure at your place of employment knowing that you're not likely to be retrenched or laid off because the company is struggling financially. The next key player interested in this financial information are trade unions. We know that several workers come together, they join a trade union, and this trade union goes ahead to negotiate salaries on behalf of these workers. And so when the trade union has access to this accounting information and financial statements of a company, then they are able to negotiate salaries of their employees. And we also have academicians who are interested in this accounting information for learning purposes. In the course of more videos to come, I'm going to be projecting financial statements. We're going to be going through cash flow statements. We're going to be understanding income statements and all other financial statements that are taught in accounting. And so for academic purposes, you'll be in a position to understand how a balance sheet looks like. So this again gives you an overview of the parties interested in financial statements except the shareholders. So this can be a full question that you could be asked to maybe state the parties that might be interested in financial statements of a company or explain, and then you go ahead to provide the rationale as to why they might need that accounting or financial statements in the very first place. Having understood what accounting is, now I want us to move on to the second key concept in accounting, which is assets. I'm sure you've come across the word assets and you're wondering, what does this mean? But I want you to be able to understand this today. When we talk about an asset of a company, this is a resource owned by a company out of its past events, out of which it is expected to generate some future benefit to the company. So let's break down this definition to understand it much better. So an asset is a resource owned by a company out of its past events. So if it's a building you constructed, if it's a car you bought, if it's an equipment you bought for the company, you bought this equipment or car using the resources of the company in the past, expecting that in the near future, you're going to generate money that is going to, of course, bring a benefit to the company in the near future. So when you construct a building, maybe it's a factory, it's a past decision you've made, money has been used, and now in the near future, this factory is going to house other things within the company. It's going to house employees, and then you will be able to actually now bring in more money for the company in the near future. Now, basically, when we talk about assets, there are two types of assets, and I want us to get this from the onset. We have fixed or non-current assets. Fixed or non-current assets. Now, every time you want to remember this, look at the background in this slide. These are buildings, yeah? Fixed assets are held by a company for a period of more than 1 year. These are fixtures. It could be land, it could be buildings, it could be motor vehicles, it could be equipment. And as you can see, based on these examples, These are fixed things. These are non-current assets. These are things that are likely to be used by an organization for more than a period of 1 year. They're going to be held for a period of more than 1 year by that specific company. And when we look at the second type of assets, which is a current asset, by appreciating fixed assets, then you can be able to appreciate current assets as well. These are held by a company for a period of less than 1 year. So it's less than 1 year. So some of the current assets a company could have could be cash at bank. Sometimes accountants will say cash at bank, or they will just say cash. Or instead of saying cash, they would rather say bank. So anyway, when you look at cash, bank, that is money. That is an asset. Money is an asset. And by the way, for deeper financial analysis, money is actually an asset. Money is property. So these are current assets held by a company for a period of less than 1 year. Debtors are also assets. Debtors are people who have a company's money. In accounting, they are considered to be assets. Yeah. Another way, another term that is used to refer to debtors is accounts receivables. This is money that is going to come into the organization. Debtors have your money, and it's expected that at some time in the near future, then they're going to make their payment. So that is our current asset. Then we have prepayments. Now, if a company is renting out its premises and it pays rent 6 months in advance, basically you've paid way before you even use the building, 6 months in advance. That prepayment is considered a current asset of the organization. So I think you can now start to see the distinction between the current and the non-current assets. But when it comes, one thing you need to note to differentiate the things much better, remember this picture in the background, fixed assets, non-current, more than 1 year, buildings, motor vehicles, equipment. When you look at those things critically, an organization will hold them for more than 1 year. Yeah. And then current assets, cash you may have in the bank, cash you may have within the company, the debtors who you're expecting to bring your money, the prepayments you've paid in advance, you've paid your rent in advance, your electricity in advance. Well, if you're a great employer, maybe you've rather paid your employees way in advance. That's a prepayment. It's a current asset of the organization. Having understood what assets are, I want us to shift to liabilities so that we draw the distinction between assets and liabilities. Now, looking at the definition on your screen, a liability is a present obligation arising out of past events of which it is expected that there will be future cash outflow from the company. So I think you're already seeing the distinction between the definition of an asset and a liability. Here we are having a present obligation that is arising out of something we did in the past. And so money is going to leave the company to actually pay for that past event we might have made a decision on as a company. And so there are also two types of liabilities, and we have long-term liabilities and current liabilities or short-term liabilities. But specifically when we talk about long-term liabilities, these are liabilities paid after a period of 1 year. An example would be that when a company goes to a bank to get a long-term loan, maybe the loan is going to be paid over a period of 12 years. That is considered a long-term liability. It's going to be paid over a long period of time, and the company will pay back either monthly, and it will also be paying back interest to that financial institution that actually gave it access to financing. So that is the long-term liability. Now, the next type of a liability is a current liability, short-term liabilities. These are liabilities that are just, they're short-term, yeah? Just like long-term, rather the first type of liability provides by just looking at its English meaning. With short-term liabilities, these are paid back within a period of less than 1 year. These are things you pay back, chap. An example would be a bank overdraft. Sometimes you could have money in a bank, you exhaust all the savings you had put in a bank, and you still want to access more money as a company. And so you ask for a bank overdraft. And once you get this bank overdraft, it's considered a current liability short-term liability that you must pay back within a period of 1 year. Then we also have creditors. These are people whose money that you have. Yeah, maybe you purchased goods or supplies for the company on credit. You didn't pay cash. So a credit could also be called account payable. It is something you're expected to pay back. You're supposed to pay back your creditors. This is a short-term liability. Then we have what we call accruals, and just like the word sounds, accruals, something is accumulating. Yeah, so these are accumulated payments. As a company, you've not paid rent for the past 3 months. You see, that rent has accrued. So that liability has increased. Your rent liability has increased. These are current or short-term liabilities. And so, to just recap this, you read the definition and then look at the 2 types of liability and think through critically to know what would be a long-term liability and what would amount to a short-term liability. Now, with what we've covered, I want you to draw close attention to this specific slide. And here we're going to be talking about equity. And every single time you see the word equity, what we mean is that these are shareholders' funds. Remember, equity could be capital that you've put into a business, it could be retained profits, or it could be all reserves. And what we mean by reserves here, maybe a company bought land 10 years ago, and the land was bought at 5 million. Over the next 5 years, the land has appreciated to 15 million. You can see here, there's a difference of about 10 million. Now, that 10 million could form part of the reserves of the company. So when we talk about equity, equity is the shareholders' funds. And then we also have debt financing. Now, here you've gone out of your way to actually borrow money from financial institutions. And simply put, as you can see from your screen, the assets of the company are normally financed using owners' contributions. If person A, B, C, D, and E want to start a company, they can either finance that company through their contributions. And the contributions is what we'll term as equity. And this equity sometimes, where these shareholders who are starting this company don't have sufficient money to finance the operations of the business from the start, then they can get that equity and add on externally borrowed funds. This amounts to liability. Hence, the accounting equation, which is very central in all your discussions as far as accounting is concerned. Now, this brings us to a central part that we have to keep at the back of our mind. Assets of a company equals equity plus liabilities. We've said equity could be money that you have had. This is your hard-earned cash as a person who intends to start a company with a group of other people. And then you discover you don't have actually enough money to finance this company whose desire you would want, which you have a desire to start. And so you go out of your way now to access externally borrowed fund. That will amount to liabilities. And so I want us to understand this equation again further because it becomes a mathematical equation. So we have assets here giving us equity plus liability. But if I'm to take you back to the previous slides about the things we've discussed today, under assets we had fixed assets and current assets. And then we now have equity plus long-term liabilities and We have long-term liabilities and current liabilities. And so by looking at this equation and appreciating the concepts we just discussed previously, then you've earned one key concept, or rather you've just understood one fundamental concept in accounting. This specific equation that provides that assets equal to equity plus liabilities. And up to this point, you must be able to know what amounts to fixed assets and what amounts to current assets. You should be in a position to know what amounts to current liabilities and what amounts to long-term liabilities. So have this equation at the back of your mind. Know how to distinguish assets from liabilities. Know how to point out, if you're given a question and there's some concepts given, probably like creditors, debtors, accruals, you have things like cars, you have equipment, you know where to place them, which are the assets, which are the liabilities. And so when you have all those things, remember at all times, assets must be equal to equity plus liability. This equation is very fundamental, and in our next slide, we're going now to understand another different concept. Having understood the key concept I just emphasized, the equation I just emphasized previously, I want us to move on to the next fundamental concept in accounting, and this is what we call a revenue. And by definition, revenue is income generated from the normal activities of the company. And so this definition will help us to appreciate one of the next key equations that we are going to be talking about, so that we know how we can compute profits of a particular company. Now, before we go to that equation, I want us now to appreciate, remember I said revenue is income you generate in the course of running the operations of a business or a company. And so as you run the operations of a business, you're going to have expenses. And again, this brings us to our sixth concept, expenses. These are costs basically incurred in generating revenue. So we talked about the income you've earned as you go about running the activities of a company. But as you get that income, you must incur some costs to generate that revenue. You know that famous, this famous quote of tumia pesa ikuzoee. So you must use money to make money. So as you make that revenue, you are incurring expenses. And expenses could be, if you're a company, maybe your company A, you could be paying rent, you're paying electricity bills, you're paying salaries, wages. We have depreciation, and this is going to be computed in more videos to come. There are different methods of arriving at how assets depreciate. Remember, if you bought a car, which is an asset, if you bought a car 10 years ago, then that car is depreciated in value over time. And that could, once it's computed for accounting purposes, then it can be considered a depreciation value and put under the expenses of the company. Then we have bad debts. These are people that were supposed to pay you, but you know they're incapable of paying you back. So they're going to be added as expenses of the company. Then we have provision for doubtful debts. Now, just like the statement provides, these are people who you know will either pay or not. So you add that provision for doubtful debts. But as a company, you're not sure whether they're going to pay or not. If they pay, well and good. If they don't, you've considered them as expenses. Also for the bad debts, some people who have your money, if they're not going to pay, at the end of the day, the company is losing money in the process. So that is an expense the company is incurring in the course of generating revenue. Some people are supplied with goods, but they're not likely to pay back. So we're going to consider such people as bad debts. So some of the other expenses are water bills, rates. We have things such as land rates, which we'll be covering in conveyancing. The company is paying taxes. Remember, taxes have to be paid as you run any sort of a business in Kenya. So these are all expenses that are incurred in generating revenue of a specific company. Our very last concept that you must understand and appreciate is profits. Each one of us, when we start a business, we need to make some money. And so we have talked about revenue and we've talked about expenses. For you to arrive at profits of a company, you must have revenue minus expenses. Remember, we said revenue is income you're generating in the course of operating or running your business. As you operate and run this business, there are expenses. You're paying rent, you're paying salaries, you have bad debts, you have rates, you have depreciation. So when you get the revenue you've generated and you subtract all these expenses, then you arrive at what we call profits. Now, dear friends, this brings you to the second equation in accounting. Appreciate the first equation and how we got there. Appreciate this second equation because it informs all the other mathematics that we're going to encounter in more content to come. And so you've just understood the basics of accounting by watching this video to the end. Consider subscribing to Nairobi Legal Insights so that you receive notifications every single time we post a video on YouTube. You can follow us on Twitter for active engagement. Our LinkedIn page is still Nairobi Legal Insights, and our Instagram page is Nairobi_legal. And I've also provided a link to our WhatsApp group. You can follow that link to join our WhatsApp group for anyone that is probably undertaking the Advocates Training Program for the year 2022. In that group, I'm able to assist people on a private basis so that they continue learning, and to also enable me continue learning from them. So the link is provided right below this video. Thank you so much for watching, and see you next time.